Revenue up 78% to $1.3 million. Gross profit more than doubling. But a net loss approaching $3 million for the quarter.
Yeah, the numbers are, well, they are pulling in two very different directions.
Exactly. Welcome to a brand new deep dive. Today, our mission is to unpack the Q1 2026 earnings materials for Cloudastructure, Inc.
That is ticker CSAI for those following along.
Right. And our sources for this are their official Q1 2026 Form 10-Q filed with the SEC and, their accompanying earnings press release.
Which is a fascinating exercise, honestly, because this is basically a masterclass in reading between the lines.
Oh, absolutely. If you want to know how to evaluate an early-stage, high-growth public company, you have to learn how to reconcile these two completely different realities.
Yeah, you have the glossy, hyper-growth story told in the press release, and then you have these dense, existential financial threats buried deep in the 10Q footnotes.
You really have to look past the marketing and understand the financial plumbing. So let's start with the product, because what they are building is actually pretty incredible.
It is. Fundamentally, Cloudastructure provides cloud-native, AI-powered video surveillance, and they pair that with a seamless remote guarding platform.
Which is a big shift from how things usually work, right?
Totally. They are moving security from this reactive toolkit where you basically just look at footage after a crime already happened to an autonomous, proactive system.
I like to think of it like having an AI robot security guard. One that never sleeps, never blinks, and is constantly processing millions of data points.
Right, it is always watching.
But the second it spots an anomaly, someone hopping a fence, a weird license plate, it doesn't just sound an alarm.
Yeah.
It immediately tags in a highly trained human operator to intervene.
Exactly. You get the scale of AI with the judgment of a real person. And looking at the Q1 2026 numbers, the market is clearly buying in. I mean, revenue was $1.315 million.
Which is a massive 78% year-over-year increase.
Yeah. And their subscribing properties grew by 79%, so the adoption is definitely there.
And the revenue streams are really showing that shift toward software, too.
Right, because cloud video surveillance revenue was about $337,000, which is up a staggering 193%.
Wow.
And remote guarding brought in $301,000, up 187%.
So the recurring high-margin stuff is just exploding.
Yeah, they do still have hardware revenue at $382,000 and installation at $295,000. But based on all that recurring revenue, their annualized run rate is now sitting at about $2.6 million.
And they are seeing a lot of traction in the multifamily real estate sector.
Oh, massive traction. They actually serve 8 of the top 10 property management companies on the NMHC 50 list.
That is wild. You don't get that kind of market penetration unless the product actually works.
Right.
And the PR actually highlights this real-world success story with a logistics customer. It was a commercial truck parking facility.
Cargo theft is a huge issue for those places.
Oh, absolutely. And they reported literally 0 cargo thefts over 3 months after deploying the platform.
0. That is the kind of metric that sells itself.
Yeah, and it led to a master service agreement for them. So the top line is booming. The product works. But look, scaling hardware, AI models, and human operators across massive enterprise portfolios, well, it isn't cheap.
No, it is incredibly expensive.
Which naturally brings us to the bottom line. What is it costing them to get this growth?
Well, there's a silver lining at first. Gross profit actually grew 115% to $710,000.
Okay, that is solid.
It is. But then you hit the operating expenses, and reality really sets in. Total operating expenses for the quarter were $3 million.
Wait, okay, so they grew revenue by 78%, but they spent $3.3 million just to make $1.3 million.
Yeah.
I mean, at what point does this scaling actually yield a profit? Or is this just the classic grow-at-all-costs startup trap?
That is the million-dollar question, or rather, the $3 million question. If you break down where the money is going, general and administrative, the G&A, is the biggest chunk at $1.383 million.
Which is up 28%, right?
Yes. But here's the crazy part. It is driven by salaries, sure, but professional services were up an unbelievable 3,458%.
3,400%.
Yeah. We will get into exactly why in a minute, but it is a massive red flag.
What about the rest of the expenses?
Sales and marketing sits at $913,000. And strangely, R&D, research and development, actually dropped slightly to $705,000.
For an AI company. Dropping R&D while professional fees explode.
Mm-hmm.
That is not a great look.
No, it is not. And the ultimate result is a net loss of $2.77 million for Q1.
Which is worse than the $2.01 million loss they had in Q1 of last year.
Exactly. So you have to look at liquidity. How long can they keep this up?
Right. How much cash do they have left?
They have $5.5 million in cash and cash equivalents. Management says they have enough to last 12 months, but they are heavily relying on an equity line and an at-the-market, or ATM, facility.
Basically selling stock into the market to keep the lights on.
Right. And when a company burns through cash this quickly, they are forced to turn to creative, often highly complex financing methods.
And in Cloudastructure's case, that complex financing literally broke their accounting system.
It completely broke it. This is actually the elephant in the room. It is the whole reason their 10Q was filed late.
Right. They had massive accounting errors regarding their Series 1 and Series 2 convertible preferred stock.
Massive. And the SEC rules around this are dense, but we can break them down. There were basically two main errors.
Let's start with error 1.
Okay, so error 1 relates to ASC 81515, which is a rule about embedded conversion features.
Right, so the preferred stock could be converted into common stock.
Yes, but it had a variable conversion price. It was tied to the lowest daily volume-weighted average price, the VWAP, of the stock.
Okay, let's pause here, because we really need to explain how dangerous a variable conversion price is.
It is brutal.
It is. It's like taking out a loan where the lender can demand repayment in the form of a larger and larger slice of your house if the neighborhood's property values drop.
That is a great way to put it.
As the stock price falls, the lender gets more shares for the same amount of debt, which dilutes everyone else, pushing the stock down even further.
It is often called toxic financing, or a death spiral. And in Q1, an investor converted just 280 Series 2 shares, but because the price was so low, they got shares at just over 56 cents apiece.
Wow. And the accounting error was that they didn't classify this variable feature as a derivative liability, right?
Exactly. They failed to bifurcate it and value it as a liability on the balance sheet. That requires complex math, like Monte Carlo simulations, which they just didn't do.
So what was error 2?
Error 2 falls under ASC 48010 S99 3A. This is about misclassification of equity.
The permanent versus mezzanine equity issue.
Right. They put this preferred stock in permanent stockholders' equity. But because it had contingent redemption features that were outside the company's control, like they could be forced to redeem it based on market conditions, shouldn't be permanent.
It belongs in temporary or mezzanine equity.
Precisely. So they completely messed up the balance sheet.
And that explains the 3,000% jump in professional fees. They had to hire an army of accountants to fix this.
Yeah, they had to restate everything. But to their credit, they did try to stop the bleeding subsequent to the quarter.
Right. In June 2026, what did they do?
On June 29, they amended the Series 2 terms. They completely eliminated that toxic variable conversion price.
Oh, thank goodness.
Yeah, they fixed it at 40 cents a share. And they also exchanged 1,170 shares for a $1.299 million unsecured promissory note with a 9.5% interest rate.
Okay, so they locked it in. It is standard debt now. But the damage was kind of already done, wasn't it?
Oh, absolutely. Management had to admit to a material weakness in internal control over financial reporting.
That is a phrase no investor wants to see in a filing.
Never. They openly admitted they lacked the technical accounting staff to understand these complex instruments, and they said it won't be fully remediated until at least December 31st, 2026.
So they are flying blind internally for the rest of the year.
Basically, yeah.
But the accounting headache is only half the problem. Because that variable conversion dilution, it tanked the stock price, which has triggered a literal existential threat from the NASDAQ.
Yeah, loud ticking clock. On February 17, 2026, they got a deficiency notice from NASDAQ because their stock fell below the $1 minimum bid price for 30 consecutive days.
So what is the timeline to fix that?
They have 180 days, so until August 17, 2026, to get the stock over $1 for 10 straight days.
Now, normally a company in this spot can just ask for an extension, right? Can't they get another 180 days?
They can ask, but there is a brutal catch. To get that second grace period, NASDAQ requires a company to have at least $5 million in stockholders' equity.
Oh. And because they had to move all that preferred stock out of permanent equity and into mezzanine to fix the accounting error?
Yep. As of March 31st, Cloudastructure's permanent equity is only about $904,000.
Wow. So they don't even qualify for the
Not
extension.
even close.
So they are out of options. What is their last resort?
The classic microcap survival move,
Hmm.
a reverse stock split. They are planning a 1-for-6 reverse stock split.
Just to artificially inflate the share price above $1 to regain compliance?
Exactly. Because if they don't, the stakes are catastrophic.
Right, the 10Q lays it out. If they get delisted, they lose liquidity, they lose analyst coverage.
And critically, a delisting would trigger an event of default under their newly minted exchange note and the remaining Series 2 shares.
Wait, so the debt they just renegotiated to save themselves could be instantly accelerated if they lose the NASDAQ listing?
Yes, the lenders could demand immediate repayment, which, based on their cash burn, would be devastating.
It is total house of cards. Which brings us to the ultimate takeaway for you, the listener. The press release tells a true story, right? It is a great product, 78% growth, awesome AI innovation, zero cargo thefts.
All true.
But the 10Q tells a parallel true story. A company burning cash, battling material accounting weaknesses, and fighting off a NASDAQ delisting just to survive.
It is the perfect example of why being a well-informed investor means you can never stop at the press release.
Never. The real story is always in the footnotes of the SEC filings.
Always.
And it leaves you with a really lingering question to ponder. I mean, can brilliant world-class AI technology actually be undone by the financial gravity of micro-cap capital markets?
It is a fair question.
When a startup goes public too soon, does the cost of maintaining the public structure, the auditors, the complex financing, does it ultimately strangle the innovation it was meant to fund?
It certainly looks like it might in this case. We will have to see if they can navigate it.
We will be watching. And if you want to keep tracking stories like this, make sure to follow the show for daily earnings coverage. Thanks for joining us on this deep dive.